Let's take a look at another example for depreciation expense. It says Jackson Company had the following events for its first year of operations. Only selected events are shown. On January 2nd, year 1, Jackson Company paid $37,000 cash to purchase equipment. The company estimated that the equipment had a salvage value of $2,000 and an estimated useful life of 7 years. At the end of year 1, Jackson Company recognized the expense of using the equipment in year 1. They want you to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. First, let's go ahead and calculate the depreciation expense for the year. We know that we're going to be using the straight line method formula. To calculate depreciation expense, you take your cost. How much is the cost? So depreciation expense is equal to cost. They told us the cost was $37,000. Then you subtract the salvage value. In this example, they have a salvage value of $2,000. And then you divide the entire numerator by the expected useful life in years, which is 7 years, which gives you 35,000 divided by 7, which is equal to $5,000 per year. That is the depreciation expense. Now let's see how these two items affected the financial statements. We'll start with the first one. Let me label that here as 1. It says on January 2nd, year 1, Jackson Company paid $37,000 cash to purchase equipment. Then they told us that the company, the estimated useful life is 7 years and the salvage value is $2,000. So from all of this, what's important is the purchase price of $37,000. How did this affect the financial statements? We know that cash decreased because they said they purchased cash to buy this equipment. Cash is an asset, and cash decreased by $37,000. Next, what happened? Instead of looking at the cost, we're actually going to show the book value in the balance sheet. A lot of your questions when you do your homework will show the book value. So book value is cost minus accumulated depreciation. And I'm going to, under assets, show something called book value of equipment. To recall, book value is equal to cost minus accumulated depreciation. Let's look at this relationship. Cost minus accumulated depreciation is equal to book value. If the cost increases, book value increases. If accumulated depreciation increases, book value decreases. So just keep that relationship in mind. So in this example, the cost of the equipment increased, which causes the book value of equipment to increase by $37,000. That takes care of the balance sheet. Does this affect the income statement? No, there's no revenue or expenses related to this transaction, so it does not affect the income statement. Does this affect the statement of cash flows? Yes, it does. There was cash involved, so we had a $37,000 outflow of cash. Therefore, statement of cash flows decreases by $37,000. What type of activity is it? We are purchasing equipment, which is a long-term asset. It's just like we purchase land in our earlier examples. Whenever we purchase a long-term asset or sell a long-term asset, it is an investing activity in the statement of cash flows. Now let's look at the adjusting entry, which is item 2. At the end of year 1, it says Jackson Company recognized the expense of using the equipment in year 1. We know that the expense is called depreciation expense and the dollar amount is $5,000. What happens here is that a depreciation expense goes up and accumulated depreciation goes up. Again, whenever we record the adjusting entry, depreciation expense increases and accumulated depreciation increases. Accumulated depreciation has the effect of decreasing book value, so we're going to show that for this item here, the book value decreased by $5,000. Again, accumulated depreciation increases by $5,000. Accumulated depreciation has the effect of decreasing book value, therefore book value of the equipment decreased by $5,000. That takes care of the book value. What about the expense part? Well, we know that expense increased by $5,000. Expense had the effect of decreasing retained earnings. Retained earnings is stockholder equity item, so I'm going to say retained earnings here, and retained earnings also decreased by $5,000 because of the expenses. That takes care of the balance sheet. Now let's look at the income statement. Did the income statement get affected by this adjustment? Yes, it did. Our depreciation expense increased by $5,000. So the income statement will show an expense increase of $5,000, which causes net income to go down by $5,000. Did this affect the statement of cash flows? No, it did not. There's no cash affected by this transaction, so the statement of cash flows is not affected. One more thing I want to show you in this example is I said there are 4 things you need to calculate depreciation: cost, salvage value, estimated useful life, and date. In this example and the ones we've done so far, the date has always been the beginning of the year. But what if the question said that this company purchased equipment on July 1st? So let's change the information to say instead of January 1st, they purchased this on July 1st, year 1. What would change? What would change is the depreciation amount. Instead of the whole year, we only owned the asset for part of the year. How much is part of the year? 6 months. If you calculate from July to December, it's all of July, August, September, October, November, December. That's 6 months. So how do we record, or rather, how do we calculate the depreciation expense? We do it the same way. We first calculate depreciation expense for the year. So step 1 would be calculate depreciation for the entire year. And we already have done that. We've determined that the depreciation expense for the entire year would be $5,000. That is step 1. Once we figured that, we prorate it for the number of months owned. So then prorate depreciation for the year for the number of months that the company owned the equipment. So when I say prorate, what I mean is you take the 5,000, which is depreciation for the entire year, and multiply it by the number of months owned, divided by 12. That gives you a percentage of months owned. So we say 5,000 times 6 over 12 because we've owned it for only 6 months. So your depreciation expense for the year is going to be $2,500. So the only difference is in item 2, book value of the equipment would have decreased by $2,500. Retained earnings would have decreased by $2,500. income statement expenses would have increased by 2.5 and net income would have decreased by 2.5. So instead of 5, all those numbers would be replaced by 2,500. If this was only owned for 3 months, instead of multiplying by 6 over 12, you would multiply by 3 over 12, and so on. Please let me know if you have any questions. Please rework this example so you are aware of how depreciation expense and accumulated depreciation are related to each other and how it affects these financial statements. That's it for this video.